Morgan Stanley says RBI likely to hike interest rates if oil soars to $110. Leading global investment bank. Morgan Stanley expects the RBI to raise interest rates again if the price of crude oil rises to $110, as this would result in an increase in inflation and a spike in the country's current account deficit. Before we dive in details, please subscribe to the channel and stay always one step ahead to know all global important events happening around you. Give a thumbs up and share the video with your family and friends. Let's move on with the video. Leading global investment bank Morgan Stanley expects the RBI to raise interest rates again if the price of crude oil rises to $110, as this would result in an increase in inflation and a spike in the country's current account deficit. Since India imports over 80% of its crude oil, the country's economy is highly susceptible to rising crude prices. A $10 increase in oil prices boosts inflation by 50 basis points and contributes to a 30 basis point widening in the current account balance, according to a Morgan Stanley report. Oil above $110 a barrel would be destabilizing for India's economy, the investment bank said, resulting in higher domestic fuel prices and second-round inflationary effects. The current account deficit would also likely widen to beyond the comfort level of 2.5% of gross domestic product, the report states. With macro stability indicators stretched under this scenario, we think currency depreciation pressures could rise and lead the Reserve Bank of India to restart its rate hike cycle, Morgan Stanley's economist led by Chetan Ahya wrote in a note on Sunday. The RBI has kept its policy rate on hold this year, as it does not want to hurt growth with any increase in interest rates. However, the central bank's policy is based on a crude oil price of $85 a barrel in the second half of the current financial year. Morgan Stanley is of the view that if oil prices remain at $95 a barrel, the Indian economy would remain manageable and the RBI would not have to go in for an interest rate hike. India's basket of crude oil imports averaged $87.09 a barrel as of November 2nd, compared with an average of $90.08 a barrel for the full month of October. The Morgan Stanley report also states that in the upcoming elections, the key risk for India's financial markets is the emergence of a weak coalition government, which could result in a pivot back toward redistributive policies at the expense of the focus on boosting capital expenditure and implementing supply-side reforms. In the face of these challenges, the RBI has a crucial role to play. The decisions it makes in the coming months will have far-reaching implications, not just for the Indian economy, but also for the everyday lives of over 1 billion people. The power of the RBI lies in its ability to control key economic levers, such as interest rates. Now, what exactly are interest rates, and why are they so important? Simply put, interest rates are the cost of borrowing money. They're a tool that central banks like the RBI use to control inflation and stabilize the currency. When the RBI increases interest rates, borrowing becomes more expensive. This discourages people and businesses from taking out loans, which in turn reduces spending and slows down the economy. This is a common strategy used to combat inflation, which is when prices rise too quickly. On the flip side, when the RBI lowers interest rates, borrowing becomes cheaper, encouraging spending and stimulating the economy. Now, let's take a look at the RBI's recent decisions regarding interest rates. In the past, the RBI has shown a willingness to increase rates in response to high inflation and a weak rupee. For example, in 2022, the RBI raised its key interest rate twice. These decisions were not made lightly. The RBI carefully considered factors such as the rupee's exchange rate, the state of the global economy, and the potential impact on India's economic recovery. However, there are times when the RBI surprises us, like when it chose to hold both key interest rates steady, despite expectations of a hike. This decision was made based on an improving inflation outlook, uncertainties related to the pandemic, and a need for continued policy support to ensure a durable and broad-based recovery. And then there are times when the RBI makes a move that's seen as slightly negative for the markets, like when it raised the policy repo rate by 35 basis points after 3 consecutive 50 basis points moves. This decision was driven by inflation remaining above the RBI's tolerance band throughout the year. As we can see, the decision to hike interest rates is not taken lightly. The RBI weighs various factors and makes these decisions with the ultimate goal of maintaining economic stability and promoting growth. The power of interest rates is indeed profound, shaping the course of the economy and impacting the lives of millions. Given the current scenario, the RBI is likely to hike interest rates further. This probability stems from a confluence of factors that are currently shaping India's economic landscape. Firstly, inflation is running high. This is a critical concern for any central bank, as unchecked inflation can undermine the stability of an economy. To keep inflation in check, central banks often resort to increasing interest rates, a tool that helps to cool down the economy by making borrowing more expensive, thereby reducing spending and slowing inflation. Now, economists are divided on the size of the upcoming rate hike. Some predict a modest 25 basis point increase, while others foresee a steeper 50 basis point hike. This division is representative of the complexity of the current economic environment, where striking the right balance is key. Secondly, the rupee's exchange rate is playing a significant role in the RBI's deliberations. A weak rupee makes imports more expensive, thereby fueling inflation. Higher interest rates can help strengthen the rupee by attracting foreign investors in search of better returns, which in turn helps to contain inflation. Lastly, the RBI is also under pressure to align with global peers who have already begun tightening monetary policy. The United States Federal Reserve, for instance, has signaled its intention to start raising interest rates. In an increasingly interconnected global economy, the RBI cannot afford to lag too far behind, as that could lead to destabilizing capital outflows. However, it's important to remember that these decisions are not taken lightly. The RBI is fully aware of the impact that higher interest rates can have on economic growth. Higher borrowing costs can dampen investment and consumption, two key drivers of economic growth. Yet, sometimes tough decisions need to be made. This decision, though challenging, is necessary for the health of our economy. It's a delicate balancing act, one that requires careful calibration to ensure that the cure doesn't become worse than the disease. In the next scene, we will explore the impact of this decision on the Indian economy. Every decision has its consequences. Let's delve into the potential impact of this decision on the Indian economy. As the Reserve Bank of India contemplates a hike in interest rates, the effects are likely to ripple across the diverse sectors of the economy. The most immediate impact of this decision will be felt in the banking sector. Higher interest rates generally mean increased borrowing costs. This could lead to a slowdown in loan growth as consumers and businesses find it costlier to borrow. This in turn could dampen the demand for big-ticket items like homes and cars, affecting industries linked to these sectors. The stock market, too, tends to react to interest rate hikes. Higher interest rates can reduce the attractiveness of investing in equities, as investors may shift towards fixed income assets offering higher returns. This could lead to a correction in the stock market, making it a challenging time for investors. On the currency front, the rupee's value can also be affected by interest rate changes. An increase in rates generally strengthens a currency as it attracts foreign capital inflows. However, this relationship isn't always straightforward, with multiple factors like inflation, trade balance, and global economic conditions also playing a role. Speaking of inflation, the primary reason for the RBI's rate hike decision is to rein in inflation. Higher interest rates can slow down the pace of economic activity, reducing demand and consequently, price levels. However, it's a delicate balancing act. While necessary to curb inflation, too high interest rates could potentially stifle economic growth. The impact on economic growth is another crucial aspect to consider. While growth has been robust, the rate hike could potentially slow this down. Higher borrowing costs can deter investment, both from businesses and consumers, possibly leading to slower economic growth. In conclusion, an interest rate hike by the RBI will have far-reaching implications on the Indian economy. While it may help in controlling inflation, it could also potentially impact economic growth and market stability. The road ahead may be tough, but with the right measures, we can navigate it successfully. As we look to the future, it's important to understand the implications of these decisions. The Reserve Bank of India's stance on interest rates is a clear reflection of its commitment to maintaining economic stability. The recent hikes, while causing some initial discomfort, are a strategic move to curb inflation and stabilize the rupee. They also signal an alignment with global economic trends, keeping India competitive on the world stage. Looking ahead, we might see further rate hikes. These would be aimed at reining in inflation while ensuring the rupee remains robust. The impact on the economy is twofold. On one hand, higher rates might dampen investment and slow down growth. On the other, they could also foster a more stable, inflation-resistant environment, promoting long-term economic health. It's key to remember, these decisions aren't made in a vacuum. They're influenced by a host of factors, from domestic economic indicators to global financial trends. and their effects will be felt across the economy from large corporations to the everyday consumer. The RBI's decisions are not just about numbers and rates, they are about the future of our economy and the well-being of our people.